So I was browsing one of my favorite websites the other day, CNBC, and I came across the Goldman Sachs very important positions list for hedge funds. Now, I was going to make another video today, but I just couldn't get this list off my mind. Something stuck out, and that something is what I want to share with you today. So if we take a look at the results, 8 out of 10 of the companies in here are basically what you would expect. They're the big tech stocks. They're top of the NASDAQ and the S&P. You've got Eli Lilly, which is becoming the new big gold standard pharmaceutical company off the back of GLP-1. It's what you'd expect, right? There are 2 companies that you wouldn't expect to be so high up on the list. One of them is Hedge, which is oil, but the other one is Uber. Now, Uber is no small cap company. It's very well known. The average person on the street knows Uber, and it's a $150 billion company. But I wouldn't expect it to be so high up on this list. Do the analysts know something that we don't? This is the smartest money. This is hedge funds. Now, I'll tell you something else. I've been an investor of Uber since October of 2022, and I've done very well. In less than 2 years, I've tripled that investment, and now the shares are worth around $75. But I think that Uber, even though it's already a $150 billion company, could get to $1 trillion market cap. And in this video, I'm going to share the one thing you really need to understand about Uber's economics. And once that makes sense, you'll see how this company is so powerful, and also the big future growth opportunity that is going to massively expand its TAM and send it on that journey to $1 trillion market cap. The great thing about it when you're considering investing in a business like Uber is it is a consumer-facing business, meaning the average person on the street actually uses it. So it gives a very clear picture to see what is going on under the lid. Now, of course, Uber have 2 main segments. They have mobility, so rideshare, and then they also have their delivery segment. They have a 3rd section called freight as well, which we won't discuss in much detail today. Now, what happened when I was first invested in Uber is you had the delivery segment where the pandemic was a massive positive catalyst, people ordering a lot more takeaways because we couldn't go out for dinner, but also it had a massive adverse impact on the mobility segment. So revenue was very clunky and it was kind of volatile, what they were reporting. And you can see that in the chart here. The black is mobility. They actually had a big decrease in 2020, stagnant in 2021, then skyrocketing. The delivery segment skyrocketed and then the growth started to slow down. But what we can see now is much more consistency. So in the delivery segment, we can now see Uber's at this steady state of 17% year-on-year growth for their bookings. And then on the mobility side, they are sort of in the high 20% growth range. Now that is very impressive, particularly given that the macroeconomy hasn't been in the strongest environment recently. Now, the biggest thing to understand about what makes Uber a success is the network effect. We all know the different types of economic moats as investors, right? And the network effect is often deemed the most powerful, but there's an extra layer of power added to Uber's network effect, and that is the one of urgency. You know, when we need a taxi, time is money, right? We need to get from place A to B, and Uber has that perfect network effect, right? Because let's say demand for Uber goes up, then more drivers come onto Uber, which means people have to wait for a shorter amount of time. That also means that Uber can bring the cost of that ride down, both from a driver standpoint and from the consumer standpoint, because the more drivers and consumers there are, the shorter that the driver is having to drive around unoccupied. So meaning, you know, if his lift gets off just here and then the next one is here, boom, that's more time that the driver's actually earning money. And it's the same for the actual customer. You know, they only have to wait 1 minute. There's not all of this lost time for them that's then effectively added into their fare at the end. So then it pushes the cost of the ride down, and then there's also more demand. So there's this extremely powerful network effect going on, that also, because Uber has a more powerful network than anyone else, they also have that scale, and then they can bring that cost down. So it's extremely powerful, particularly when there's a sense of urgency. You could say that other companies like Airbnb have a network effect where, yeah, they list a load of properties and then people use Airbnb because Airbnb's got more properties listed and there's more customers. So the hosts want to list on Airbnb as well, right? I'm an Airbnb host. but there's not that same sense of urgency. You can browse Airbnb for 10 minutes, then you can go to booking.com, and you want to make a very slow, deliberate choice about where you want to stay because you're paying a lot of money for it. Most of the time with Uber, it's 20 bucks, get me from A to B as soon as possible, right? And Uber also have that intellectual property, that intellectual brand. I remember the first time that I ordered a rideshare from my phone and not a taxi. What somebody said to me, I hadn't heard of it before, is they said, get an Uber. They didn't say get a rideshare on your phone, they said get an Uber. So Uber's a verb in many places. I've seen that it's a verb in the States for sure. It's definitely a verb where I live in the UK, and they've got massive market share in both of those countries. In countries where Uber have not got as much penetration yet, they're working on making Uber a verb. It means that it's incredibly powerful because it's like free advertising for them. Get an Uber. It's an easy thing to say. Get a rideshare vehicle that's not a taxi, right? You've got to remember that the core value proposition for actually getting a ride on your phone in the first place is manyfold, right? If you're a tourist in particular, waiting around for a taxi, trying to find a taxi rank, and then what's happening is time is money. So you're also paying for that time that taxi driver has been sat there idle, because they've got to feed their family at the end of the day. If they've been sat there idle for half an hour and then got a half an hour taxi ride, you in effect have to pay double just to cover their wage, right? So that brings the cost of taxis up. And then there's also that element of trust. I actually think people trust an Uber more than they do a taxi because you've got the protection of the app. The app knows where you are. The app knows exactly who is driving you, and you've got that pre-agreed cost before you get in. There's none of this rubbish with, the stress of the meter going up and up and up, and you can see where you're going and you can see the destination. It's just a much safer, simpler way to do things, and you've got the driver's profile there with all of these reviews. So you at least have some proof about exactly who's taking you. So there's clearly demand for the service, which is why Uber has grown in terms of cost, convenience, speed. They've made a massive positive iteration on the legacy taxi industry, and they've got this extremely powerful network effect. Aside from that and the brand, they've also got decent switching costs now. So look at this. Customers are using more than one of our products and spending more on the platform. So you can see the number of customers that are using more than one product is going up. Uber have this monthly membership called Uber One, where you pay a monthly fee, and it allows for free delivery on a lot of restaurants, cheaper delivery on all restaurants, and also you can get cashback for the rideshare service. So what that does is, for people who both get takeaway sometimes through their phone and also rideshare through their phone, Uber's a one-stop solution for them. And the fact that they subscribe makes it cheaper and also encourages that stickiness. So that is a very, very powerful thing that they have. Now, also Uber, their competition is there, but it's really not that much. Here we have a table where we can see Uber compared to the public competitors. I think the most prominent ones, other than some of the Chinese ones that are not public, Bolt is quite big in Europe. But anyway, here we've got the main competitors, and you can see the turnover or the revenue for each one of them, and then look at the growth. So Uber is pretty much growing in line with these other three companies. DoorDash is delivery, Lyft is mobility, Grab is both, and Grab is sort of prevalent in Southeast Asia. But you'll notice that the growth rates are similar, but look at Uber's revenue, right? 37 billion. So they're adding more and more revenue all the time. They're maintaining that market share, and they're squashing the little players like Deliveroo and Just Eat out of the market. Lyft used to be taking market share away from Uber, right? But remember what we just saw. Uber's delivery business is growing slower. Their mobility is reporting bookings growth in the high 20s. So that is much faster than Lyft's 17.8% 3-year forecasted annualized turnover, because they are just in the mobility segment. So now Uber's taking market share away from Lyft, and that is because of the reasons that I've just mentioned. Okay, so what about that massive opportunity that I was hinting at earlier that I think could catapult Uber's market cap over $1 trillion? Well, I'm talking about autonomous driving. Now, this is a big topic. It's a topic that I'm very passionate about, so I'll try to keep it brief here and just explain the overview. Self-driving cars are coming. They are progressing all the time, And Uber is partnering with the big people. Why are they progressing? They're getting safer all the time. Road traffic accidents are up. Alcohol, drink driving is a big issue. People on their phones are a big issue. Human error is an issue. And the smarter the AI is getting and the more precise this technology is getting, the more data that the cars have that they're trained on, the safer that the AI-driven cars are getting. And thus, eventually they will eliminate the vast majority of car accidents and ultimately save lives, right? It's a very good thing. So, thing is that a lot of people are quite apprehensive about getting in self-driving cars, right? Now, there are companies that are making headway, and there are a couple that are actually already charging, making money, and doing their thing with self-driving cars. The market leader in some respects at the moment is Waymo. They've actually got the furthest with level 4 autonomy. So this is where you're actually sat in the back of the car. They've removed the safety driver because they're confident they've got enough data that that car can drive well enough. They get approval. They've got it in a few key areas in the United States, and now they're charging for that service. Waymo do have their own app, but what's the problem? Lack of network effect. So they're using Uber's network effect. And this is what will happen. It will say, you've matched with an autonomous vehicle 3 minutes away. What it will do is it will expose the masses to the autonomous driving to give them an option, because who's going to download the Waymo app specifically just to get in an autonomous car? Autonomous car enthusiasts, right? Now, that may be a certain small percentage of the population, but it's not everybody. But when people actually experience it and they realize it's safe, it's very effective, and also the costs, right? The vast majority of the costs when you're taking an Uber is that driver, right? Uber's gross margins are very low because their bookings includes the cost to the driver, right? It includes paying the driver. So their margins are low. Their margins are in the high 30s because the majority of that money goes to paying the driver. My point is that when you remove the driver, you can cut the cost of driving massively, particularly when these self-driving cars hit scale. So that's where we're going effectively. And Uber's app will expose the masses. Imagine when they're at scale and it will say, okay, you can take an Uber with a driver for $30, or you can take the self-driving one for $20, right? And there are also just things like, imagine if you've had a few drinks and it's late at night and you just don't feel comfortable with a human driver. You never know. You may be in that kind of situation. You just want to get home. You just want some privacy. Maybe you're having a private phone chat and you don't want to be overheard. It's all of these kind of things. Maybe your driver is not driving appropriately, right? So there's all these things that self-driving cars fix. And Uber is partnering with some of the key players. They've got a deep partnership with Waymo, the sort of actual concrete market leader in charging money and doing level 4 autonomy today. They just announced a partnership with General Motors, who unfortunately their license was revoked last year, but they should be able to get it back in California. And then there's Motional, which are doing very well, and Aurora as well, which spun out of Uber. So they've got these deep partnerships with all of these companies. And these companies, particularly when it becomes an arms race, right? Where are they all going to go? They're all going to go to Uber because they've got the existing eyeballs. So Uber benefit regardless. You're buying a really good existing business here. They've still got a massive TAM. They're still growing in many countries. And look, high 20s growth for mobility, teens growth for delivery, very, very good. And for example, we also can't talk about autonomous driving without talking about Tesla for a minute. A lot of people say Tesla's the market leader because they are basically all of the cars that are out on the roads now, they're collecting that data. So Tesla has got an extremely rich data network. And then instead of doing level 4 autonomy, which is basically where the car is going around a pre-mapped city, a city where it knows very well and it's trained on that data, the theory is that you will be able to basically put a Tesla car anywhere on roads that it's never seen before because it's collected so much data and the AI has been trained on other roads. If Tesla are going to win the self-driving race, this is still going to benefit Uber. I'll tell you why I think so. 97% of the time, cars are stagnant, right? They're not being used. So there's going to be a market when it's autonomous, people can lease out their own cars. I'm not saying everyone's going to do that. I'm saying if you've got a car and you lease it out, you can make some extra money from it. And some people will go down that option. And where are they going to do that? They're going to do that on Uber, right? It's just the other side of the coin. So Tesla is going to become the supply, there's always going to be demand for people to travel, and Uber becomes that middleman. It's a massive, massive opportunity for them. So for valuation, I still wanted to show that even though Uber's tripled in the last 3 years, it still looks reasonably cheap. Now, what I've done is I've compared it to companies where their market cap is similar, so in that 50 billion to 150 billion range, growing at similar rates. I know not all of these companies are similar. DoorDash is obviously pretty similar. Spotify is an app, but it's kind of software, and it's yeah, some of them are a bit different, right? I understand we can't compare completely apples to apples here. But what I'm saying is, given that they've got these growth rates in the teens, Uber still looks reasonably cheap. So if we compare it to DoorDash, for example, DoorDash are trading at 13 times gross profit, Uber's trading at 10, and they're trading at similar forecasted price to free cash flows. Uber's got a cheaper PE. Yes, Uber's growing marginally slower, but remember how much more money they are making, right? Uber is the market leader. So for them to be trading at this, given that they're the market leader and they've got that scale and they've got that huge network effect and they've got that diversity, it's pretty good, reasonable value. I also wouldn't say that DoorDash was the most overvalued company ever. 13 times gross and 27 times forward cash flow for 18%, 3-year forecasted annualized turnover growth is pretty decent as well. And then Spotify, you can see they're trading at 19 gross. Again, similar growth, but Uber's got cheaper numbers on there. Someone like Intuit is like similar kind of market cap, similar kind of growth. You know, their multiples are more expensive than Uber's, given Uber's got faster growth as well. Similar story with Adobe. Again, SaaS companies, yeah, maybe they should get some premium. How far is Uber from SaaS? It's platform as a service. And this is the thing, is that because it's more of a platform as a service, they're not having to invest so much in R&D. And a lot of that means that from their gross, a lot of that gross falls to the very bottom line, which is decent. And you think when autonomous driving comes, it's going to help expand Uber's margins even further. So yeah, I mean, looking at Airbnb as well, you know, gig economy, fine, they're a little bit cheaper on the multiple at 9 times gross, only marginally, but you know, 10.7% 3-year forecasted annualized turnover, when Airbnb, they're actually not making that much in turnover compared to Uber. So Uber looks very reasonable. Now, turning to discounted cash flow, you know, they're doing pretty well here. So I've got it going from 15 down to 10 over the next 10 years, 16% free cash flow margins, which they're already forecasted to do by analysts in FY26. From these numbers, you get a present value of $101 and the current share price is 72. So on a stock that is quite stable and quite well watched, I mean, pretty well watched given it's in the top 10 of these hedge funds, but not exceptionally well watched. I wouldn't say that it's the most well-known stock. It's a very well-known company, but it's not the most well-known stock. They look pretty good on a DCF. To get 39% upside here, really decent. And then you've got a fair amount of margin of safety to say, yeah, if these growth rates tail off quicker, or if the FCF margin is not as high as projected, there is still a decent margin of safety on this company. And what you've got to remember, if the company's growing at 15, then it only has to maintain these multiples, you know, the gross margin multiples, the PE multiples, to return 15% a year. If these multiples expand and they grow the top line 15% a year, that means that the share price is going to do more than 15% a year. So there we go. That's Uber. I will be covering Uber more regularly. I'll be covering it after earnings because this is a stock that I've been invested in for 2 years, and now, you know, I made a good return out of it. I've not got as much money in the stock now than I did before, but now it's like, it's going to be an extremely steady 5 to 10 years, in my opinion. And I think in the long run, they can reach that $1 trillion mark because they're clearly focused on this autonomous driving market. They're making the right strategic partnerships. And when this takes off, it's going to massively bolster their revenue and the total addressable market. Thank you for watching the video.